Okay, good morning, class. Now, let's actually start today with what we have is called financial institutions. Okay, so how do we go about? These are the topics that we have, right? All 6 topics. So we'll go one by one. The first topic is the economic analysis of the financial structure. That's what we are going to talk of, right? So, some of the basic facts about the financial structure throughout the world, right? So, basically, when we talk of this topic, it provides an economic analysis of how our financial structure has been designed worldwide to promote. Main thing is to promote economic efficiency. So, we will show in the next slide, which shows how American business financed their activities using external funds during the period of 1970 to 2000, and then it's a comparison with that of Germany, Japan, and Canada, right? So this is the picture that you have. This is the diagram. So there are some 8 facts, and we will be relating to these facts, right? The first is that stocks are not the most important sources of external financing for businesses. Second, that comes up is issuing marketable debt and equity securities is not the primary way in which business finance their operations. Third, that comes up is that indirect finance is in many times more important than direct finance. And fourth, that comes up is where we are talking of the financial intermediaries, like particularly banks, which are the most important source of external funds, which is used to finance any businesses. Fifth talks about the financial system. That financial system is among the most heavily regulated sectors of the economy. It's bound to happen because money is involved, and where money is involved, there's always possibility of some misappropriation of funds happening, scams happening. So it's most regulated, and only large well-established corporations have easy access to security markets to finance their activities. Obviously, why? Because they are already well-established. They have their credibility. Collateral is one of the prevalent features of debt contracts for both households and businesses. You need to have a collateral when you have to take any loans. Debt contracts are extremely complicated legal documents that actually place some restriction covenants on the borrowers. Because when you take loans, you have to sign some legal documents. There are some restrictions which would actually make the borrowers think whether they would take it and what are the terms and conditions under which they would take. So these are the 8 basic facts which we would be referring to quite often in this chapter. So transaction cost. Now what happens is all the financial intermediaries, right? Why have they been evolved to ensure that there is a reduction in the transaction costs when transaction takes place, right? Transaction of goods and services, transaction of money. So which means what? There is economies of scale, and there are a lot of expertise which is involved up there. So financial intermediary, what are they? They're actually the institutions which act as a middleman from the transfer of funds from individual businesses and other entities with surplus funds to those who borrow, helping to transfer the money from one who wants to lend to those who want to borrow. And an example of a financial intermediary is a bank, where what happens when they have the people are depositing money. So bank has bank deposits, and then bank uses that funds to give them as loans, right? So why do financial intermediaries exist, right? To address the problems which arise in asymmetric information, right? When both buyers and sellers do not have the right information, which can result in some adverse selection and some moral hazard problems. So financial economies of scale, or the ability to spread cost of managing funds across large number of savers. So that's why it is these financial intermediaries are there, to ensure that there is financial economies of scale, and also to ensure that the cost of managing funds across different large group of savers, that can be done. So what is, we just talk about the more adverse selection and moral hazard. So what exactly are this? When we talk of asymmetric, we also spoke about something called asymmetric information, right? We had this. So we will discuss all these three. Asymmetric information is possession of information by one party in a financial transaction but not by the other party. One of them is having the information, other doesn't have it. So that's why asymmetric. Everyone doesn't have the same information. Adverse selection is the possibility that those who wish to actually issue the financial instruments, they have it in mind of using the funds they receive for unworthy high risk projects, right? That's adverse selection. They're using it for unworthy high risk projects, right? Moral hazards, it's the possibility that the borrowers who are borrowing the funds, they might engage in some more risky behavior after a loan has been made. Like before that, they do not say, after it's been in. So they use it in some risky projects, and which may lead it to problem. Economies of scale, it's the reduction that can be achieved in the average cost of managing funds. How? When you can have savings, when you pool in savings together and then spread the management cost across many savers. More people are there. So what happens? The cost of managing funds can be actually spread out on multiple people. So the individual each person has to pay less cost of managing or less cost of managing these funds. So asymmetric information, that's what we said, where we have adverse selection and moral hazards. Now, adverse selection happens before the transaction, right? When you don't have right information and you end up making the wrong purchase. Moral hazards happens after transaction, where you say something and once you get the funds, you use it for some other risky projects, and when the other party doesn't know. So agency theory actually analyzes how asymmetric information problems affects the economic behavior. So we're going to actually talk about Lemon's problem, that how adverse selection influences the financial structure. But we first need to know what is the Lemon's problem. It actually refers to any issues that arises regarding the value of any investment or product due to asymmetric information possessed by the buyer and seller. So this problem was actually put forward by in 1960 by George Akerlof in his paper The Market for Lemons, Quantity, Uncertainty and Market Mechanism. Akerlof was an economist and professor at the University of California, Berkeley. Right, this Lemons problem, right? It's basically it comes up in identifying the problem, which is problem that came up with regards to that of used cars, right? That's how the name came up. So where Akerlof actually illustrates the concept of asymmetric information as as defective used cars are commonly referred to as lemons, right? That's why Lemon's problem. So what happens is, when we talk the problem of asymmetric information, right? Why does it occur? Because buyers and sellers do not have equal amounts of information which is required to make a decision, a proper decision regarding any transformation, any sort of transaction. So the seller or the holder of a product or service actually knows the true value, right? Or at least they know whether it is above or below the average in quality, right? But the buyers, potential buyers, they do not have this knowledge. Why? Since they are not privy to all the information the seller has, they do not have that privilege, right? But the buyer sellers have it. So Akerlof, like if we say, like when he came up with this problem, he gave the example. His example was purchase of a used car, right? Where the potential buyer of a used car cannot easily actually determine the true value of the vehicle. So what happens is, they may be willing to pay not more than an average price, right? Which they feel is somewhere between the bargain price and a premium price, right? And so if the buyers actually go with such an policy, what happens? It may at first appear that appear to offer the buyer some degree of financial protection from the because from the risk of a, buying a lemon, because there's always a risk that they may end up buying a defective car, so they would prefer to go somewhere in the average price. But what happens is this later on actually will be favoring the seller. Why? Because when the sellers receive an average price for a lemon, it would be still more than what the seller would have got if the buyer had full knowledge about that car and wouldn't have bought it. So since the buyer does not have full information, that's why they're paying that average, but it's still more. So actually what happens is the lemons problem, it creates a disadvantage for the seller of a premium vehicle, which is really good. Why? Because the potential buyers do not have full information, so they fear that they may actually get stuck with a lemon. So which means that they are not willing to offer a premium price for a vehicle which is of superior value. So it can be like, if it's a lemon, really a lemon, then and buyers are paying, then sellers are at an advantageous position. But if it's a really superior quality vehicle, then it's the sellers are at a disadvantageous position. So what can be actually done? Warranties and information. So Akalov had proposed strong warranties as one means of overcoming the lemons problem. Why? As they can protect a buyer from any negative consequences of buying a lemon. So you have the warranty. If it is not working, you can return it. So the explosion of readily available widespread information, which is available through the internet, has also helped in reducing this problem, right? You have some of these information services in the US, which is Carfax, Angie's List, which helps buyers to feel more confident in making a purchase. And they also benefit the sellers. Why? Because they enable them to command the premium prices for genuinely premium products. So you can actually quote a good price for a very good product, and buyers are able to see it. So that, it benefits both buyers and sellers. Okay. So, but if quality cannot be assessed, then what happens? Buyer is willing to pay at most a price which reflects an average quality, right? And sellers of good quality items will not want to sell at the price for average quality. They will not. Buyers will decide not to buy at all, because all that is left in the market is poor quality items, because if the quality service is not known, what happens? Buyers want to pay only average quality, price of average quality. Sellers do not want to sell it. Then what happens? Buyers have only what is option left for them is poor quality items, and then they do not make any purchase. Decide. So this actually this problem explains the fact two. What is the fact two? That is, we had spoken about those 8 facts. That is, issuing marketable debt and equity securities is not the primary way in which business finance their operations. Right? It explains. And partially it explains also it explains fact 2, but then partially explains fact 1. Fact 1 is stocks are not the most important sources of external financing for businesses. Okay. So tools to actually help solve the adverse selection problem. First comes up is private production and sale of information, right? So which would be helping in solving the free rider problem. Government regulation to increase information. So it doesn't it no, it no not always it works to solve the adverse selection problem, which actually explains fact 5, that the financial system is amongst the most heavily regulated sectors of the economy, right? So government regulation does help, not always, but it helps. Financial intermediation, which again explains fact 3, 4, and 6. Fact 3 says indirect finance is many times more important than direct finance. Fact 4 says financial intermediaries, particularly banks, are the most important source of external funds, which is used to finance businesses. And fact 6 talks of only large, well-established corporations have easy access to securities market to finance their activities. And we have also collateral and net worth, which explains fact 7, which says collateral is a prevalent feature of debt contracts for both households and businesses, right? So, how moral hazard affects the and it says principal agent problem. Principal is actually the stockholder who has less information and the one who actually who has more information, right? So that's where the problem comes out. Like managers do have more information and they do not share it with the stockholders. So there the problem comes up. And also there is something called separation of ownership and control of the firm, right? Where managers actually pursue their own personal benefits and power rather than the profitability of the firm, rather than they're thinking only about themselves rather than thinking about the profit of the firm, which means the stockholders would also get it. So that's where things come up. So what are the methods to actually solve the principal agent problem? First is monitoring, right, which is a costly state verification, like it's very costly to avoid, which would help in avoiding free rider problem, and which is actually talking of fact 1, which is stocks are not the most important sources of external financing for businesses, right? Government regulation to increase information, which is where we talk of fact 5, that is the financial system is among the most heavily regulated sectors of the economy. Financial intermediation talks of fact 3, that is indirect finance is many times more important than direct finance. And we talk of debt contracts, which is again fact 1, where stocks are not the most important sources of external financing for businesses. You can go for debt contracts also. So, how moral hazard influences financial structure in debt markets? What happens up here is borrowers have incentives to take on projects that are more riskier than the lenders would actually give, right? So, which prevents the borrower from paying back the loan. So, when you take on projects which are much more riskier than what the lenders would actually want to give you, which actually what happens in that case, otherwise what would happen, the borrowers would not pay back the loan. So if the lenders are actually stopping it, then it prevents the borrowers from it prevents the borrowers from paying back the loan, right? Because if they take on if they take up projects which are quite risky, then what happens? Then the problem comes up. They will not. They have a tendency not to pay back. So that's where the borrowers actually borrowers are being stopped, right? So, how do you solve the moral hazard problem in debt contracts? First comes up is the net worth and collateral, right? You need to find out the net worth of the securities and the collateral that borrowers are willing to are giving. So, which is an incentive compatible. So, you need to actually see if the borrowers are not able to repay back, then the collateral can be the lenders can actually take away the collateral. Okay. Then next comes up is monitoring and enforcement of restrictive covenants. One is which discourages the unethical or undesirable behavior, and obviously encourages to say desirable behavior. It keeps the collateral valuable and provides information. And the third is the financial intermediation, which is again talking of fact 3 and 4. That is, indirect finance is many times more important than direct finance, and financial intermediaries, particular banks, are the most important source of external funds used to finance businesses. So this is a table that we have of asymmetric problems, the different problems that we have: adverse selection, moral hazard in equity contracts, and where we talk of principal agent problem, moral hazards in debt contracts, and these are the tools that we have which would help in solving, right? So you have this. These are things that we have. We just discussed this. So, asymmetric information in transition and developing countries. What happens there? So, financial repression is where we have a financial downtown pressure. It's created by an institutional environment which is characterized by where we have poor system of property rights, where you are unable to use your collateral efficiently, right? You want to use your collateral to get loans, it's very difficult to get. Where you have a poor legal system, it becomes difficult for lenders to enforce restrictive covenants, weak accounting standards, where you have less access to good information, and government intervention through direct credit programs and state-owned banks, right? Where there is less incentive to proper channel funds to its most productive uses. Right. So how when we talk of financial development and economic growth, right? What happens? How has it been related? The financial systems in these developing and transition countries, they face difficulties, right? They have difficulties which actually prevents them from operating very efficiently. So in many of these developing countries, what we find, the system of property rights, right? Property rights is the rule of law, then the constraints on the government expropriation, absence of corruption. Like they do not function properly. The system, the property rights, system of property rights does not function properly, which actually makes it very difficult to use these two tools. That is where we talk of these tools, right? It's very difficult to use these tools quite effectively. It's very difficult, right? Okay, we go to the next topic that we have, that is where we talk of banking and the management of financial institutions, right? So banks, bank is an institution which collects money from those who are saving it out of their incomes, and it lends this money to who require it, that we know this. And among all the depository institutions, it's a commercial banks who are the dominant players. And they are also the oldest and most diversified amongst all financial intermediaries. Banks play a very important role in channelizing funds, about $6 trillion annually, to finance all productive investment opportunities. And they also provide loans to businesses, finance college educations, allow us to purchase homes and mortgages. It's there. So what is a bank balance sheet? Balance sheet is a list of a bank's assets and liabilities. What a total assets is total liabilities plus capital, that is net worth capital. The balance sheet actually lists the sources of bank's funds, that is liabilities, and the uses to which they are put, that is assets, right? So bank actually invests these liabilities into assets to create value for their capital providers, right? It's a statement of its assets, liabilities, and net worth at a given point in time, right? Bank's assets also indicates of what the bank owns, like how, the uses of funds, right? Bank's liabilities are indications of the claim on the bank that are held by external entities, right? That is sources of funds. And net worth is a residual term which is calculated by subtracting total liabilities from total assets, so the capital. When we talk of banks' liabilities, as we said, these are it's sources of funds. What do we include here? First comes up is checkable deposits, which are the bank. It's a bank accounts that allow the owner of the account to write checks to third parties, right? Checkable deposit is an asset for the depositor. Why? Because it's part of his wealth, but it's a liability for the bank because the depositor can withdraw funds at any point of time from his account, right? So how do banks obtain funds? By issuing debts or liabilities in the form of demand deposits, which we've studied earlier, savings deposits, and time deposits. By borrowing funds from other banks or public, or by obtaining equity funds from the owners or shareholders of the bank through their capital accounts. So what do banks do when they use these funds to grant loans and invest in securities? They invest in securities, and what happens up there is they purchase equipments, facilitate and hold cash items. Say currency and deposits in other banks. So these are all bank assets. Second source of fund under bank liabilities is where we talk of non-transaction deposits. That is where owners cannot write checks on non-transaction deposits, that is time deposits and savings deposits. What happens is it takes time, like you cannot just withdraw money, you need to give time, and then only after a certain span of time, like can you actually withdraw money. So it cannot be done so easily. And so what happens, the interest rates are usually high here, right? Borrowings. Banks obtain funds by borrowing from central bank, other banks and corporations, right? So we have discussed this earlier that borrowing from central bank, it's called discount loans, right? Bank equity capital. So which is the bank's, this is the bank's net worth, right? Which is the difference between, we said that total assets and liabilities. And the funds are raised by selling new equities, that is stocks, or from retained earnings. So what are the bank's assets? Bank's assets are its uses of funds, which includes reserves. These are either the bank deposits held at the central bank or currency that is physically held by banks, which is called vault cash. So one is a required reserve, which is reserves consist of required reserve and excess reserves. It has been discussed earlier. Required reserve is a certain fraction of the deposits which must be held as reserves by law, right? Extra reserves are the reserves which is held above and beyond the amount that is being needed for required reserves. So banks sometimes keep an extra reserve also. Okay. Second comes up is bank cash items in process of collection. What is that? I'll tell you with the help of an example. So suppose a check is written on an account at another bank, okay? And someone is writing a check in their account, and it's given to you and you're depositing in your bank. So what happens? The funds of this check have not yet been received from the other bank. You've just deposited, it's not yet received. So the check here is classified as a cash item in the process of collection. It's an asset. Why? Because it is a claim on another bank for funds which will be paid within a few days. Like your bank is actually claiming that amount from the other bank, right? From where the check has been given, that money will be collected, money will be deposited. So that's a claim. So that's what we say, cash items in the process of collection. Okay. Third comes up is where we talk of deposits at other banks. Many small banks actually hold deposits in large banks in exchange for a variety of services, which can be check collection, foreign exchange transactions, and also help with security purchases. Small banks do not have these facilities. Securities, banks' holdings of securities are an important income earning asset, right? Which is also called the secondary reserve. Why? Because it's the most liquid, that can be easily traded and converted into cash with low transaction cost. Loans. Loans is a liability for the individual or the corporation who's receiving it, but an asset for a bank, right? And loans are actually less liquid than other assets because they cannot be turned into cash until the loan matures, only when it matures, right? And with loans, there's also has a high probability of default than other assets. People may not be able to repay the loan. So because of the loan lack of liquidity and high default risk, what happens? Banks tend to earn highest returns on loans, right? Because risk is high. It could be other assets, that is the physical capital, bank buildings, computers, and other equipments which are owned by banks. Basic banking, right? So banks, how does it go? Banks actually make profits by selling liabilities with one set of characteristics, so which is a combination of liquidity, risk, size, and return, and use that to buy assets with a different set of characteristics. So this process is known as asset transformation. Say for example, what happens is a savings deposit held by any person can provide funds which will help banks to make a loan to another person, right? So Someone's money, I deposit money in the savings account. With that money, banks keep a portion of it as their reserves and uses the other to give loans, and that's how they make money. So the process can be summarized as follows. Like when a check is written on an account at any bank is deposited in another, right? The bank receiving the deposit gains reserve, which is equal to the amount of the check, while the bank on which the check is written sees its reserves fall by the same amount, right? So that is as your transformation happens. Okay, so general principles of bank management. The bank manager has four primary concerns. First, to make sure that the bank has enough ready cash to pay its depositors when there are deposit outflows, right? There has to be enough money. So that's called liquidity management. Second thing is the bank manager must actually pursue an acceptably low level of risk, right? By acquiring assets that have a low rate of default and diversifying the asset holdings, which is called asset management. Diversify the assets and have ensured that the degree of risk is low. Third, uh, third concern is with requiring to acquire funds at low cost, which is liability management. And finally, the last one is the manager must decide the amount of capital the bank should maintain and then acquire the needed capital, right? That's called capital adequacy management. So we have liquidity management, asset management, liability management, capital adequacy management. So these are the four principles. So let's go into a little more details. Liquidity management and the role of reserves. Required reserves, we know these are equal to what is it? The amount of demand deposits multiplied by the required reserve ratio. Whatever is the the reserve ratio into total amount of demand deposits. When you multiply that, you get the required reserves. Excess reserves is the reserves which is held above and beyond the amount which is needed for required reserves. Anything extra. So the total reserves or the actual reserves will be for a bank is required reserves plus the excess reserves. Excess reserves banks keep it for emergency purposes. Assets management, right? So what is when we say asset management? So what happens? To maximize profit, bank must simultaneously ensure that the highest returns possible on loans and securities. They should be reduced in risk and make adequate provisions for liquidity by holding liquid assets, right? So how do banks actually achieve this? Banks should find borrowers who will pay high interest rates and are unlikely to default on their loans. They will repay back, right? Secondly, banks would try to purchase securities with high returns and low risk. Third, banks in managing their assets must attempt to lower risk by diversifying in different portfolios. This can be done where by purchasing many different types of assets and approving many types of loans to a number of customers, different variety. And fourth comes up is where the bank must manage the liability liquidity of all its assets so that what happens is it can satisfy its reserve requirements without bearing huge cost. Okay, which means what? That this means that holding of liquid securities, even if they earn lower return from other assets, still having liquid securities. But it's not wise for a bank to be too conservative, right? If it avoids all costs related with deposit outflow by holding only excess reserve, so losses are suffered. Why? Because reserves do not earn any interest, right? And but on the other hand, bank liabilities are costly to maintain. So bank must actually balance. This is important. They must balance its desire for liquidity against the increased earnings that can be obtained from less liquid assets, right? So one is to maintain the reserve, other is to increase their earnings by actually giving out as loans. So that has to be there. It should not happen that they have so much extra reserves and then reserves don't have any interest and then they give less money for loans, they give out less. So what happens? The returns become less, the liabilities are huge, right? Bank liabilities, so it becomes difficult to manage. So that has to be a balance. Third is liability management. So in the right from 1960s, what the large banks, they were actually, because they had started to explore ways how liabilities on their balance sheet can provide them with reserves and liquidity. So which led to an expansion of overnight loans market. So that's how the loans market came up, and the development of new financial instruments, that is a negotiable certificate of deposit, CD, right? So banks have to make that's where we talk of liability management, right? So they came up with this, the loan and CDs. Fourth is capital adequacy management. Banks need to make decision about the amount of capital they need to hold, how much money capital they should hold. But there are three reasons. One, bank capital prevents bank failure, right? So money if you have, and the amount of capital also affects returns for the owners of the bank. Why? Because given we know the return on assets, lower the bank capital, higher the return for the owners of the bank. Because uh, when you have banks have capital on hand, it does not earn any interest, right? Whereas if you give it as a if you give it for loans, then what happens? The returns come up, right? So that's why a decision has to be made how much money has to be kept. And third is a minimum amount of bank capital is required by regulatory authorities. That has to be maintained also. So the practicing manager. So some of the strategies for managing capital. What should a bank manager do if she or he feels that the bank is holding too much capital? Sell or retire some stock, increase dividends to reduce retained earnings, increase asset growth through certificate of deposit. Reversing these strategies will help a manager if he or she feels that the bank is holding too little capital. That is, issue stock, decrease dividends to increase retained earnings, and slow the asset growth, right? So you can actually withdraw some of these debts. How bank capital helps prevent bank failure. Now, banks are exposed to several types of risk. First is default risk, the risk that is the loan will not be repaid. Second comes up is interest rate risk, that is the risk that interest rates may rise after securities have been purchased. So what happens, which actually leads to decrease in the price of securities, right? Third comes up is liquidity risk, the risk that depositors may pull out their funds at any point of time. Fourth comes up is foreign exchange rate risk, the risk that exchange rate may move in a way which causes losses to banks. Fifth comes up is political or country risk, which involves the possibility that a bank's funds or assets outside the country may be confiscated or otherwise prevented from being returned to the same country. So, because of a political situation or the an instability in in the foreign country. Second comes up the fact how the amount of bank capital affects returns to equity holders, right? Since the owners of a bank, they know, they should be knowing whether their bank is being managed well. They need good measures of bank profitability, right? A basic measure of the bank profitability is ROA, that is return on assets. Return on assets is net profit after taxes divided by assets. So it actually indicates how much profit will be generated on an average by each dollar or each assets, right? When for each dollar or each assets, what will be the net profit generated? So that's return on assets, right? Now, what happens up here is like we just continue with it, that what the bank owners care, you know what, is how much the bank is earning on their equity investment. That's why we said on equity holders, right? That's why the equity is coming. So they just are concerned, the owners of the bank, they're just concerned about how much the bank is earning from their equity investment. So how would they know this information? This information is provided by the which is called the other method, the other basic measure of bank profitability, which is ROE, that is return on equity, which is net profit after taxes divided by equity capital, right? So there is a direct relationship between return on assets and return on equity, and this relationship is determined by what we call as equity multiplier. Equity multiplier, which is the amount of assets per dollar of equity capital, right? Equity amount of assets per dollar of per unit of equity capital per dollar, right? So ROE is equal to ROA into EM. So what does this say? This equation tells us what happens to the return on equity when a bank holds a smaller amount of equity for a given amount of assets, right? So higher capital to assets ratio when the capital is high, assets, right? So which means what? Equity multiplier, if this increases, then equity multiplier decreases. So when this equity multiplier decreases, so return on equity also decreases. Okay. Bank capital requirements. Banks hold capital. Why? Because they are required to do so as per the regulatory authorities. And to lower the amount of capital relative to assets and raise the equity multiplier, right? So reduce the amount of bank capital. How? By buying back some of bank's stock. The bank's capital can be reduced by paying out higher dividends to its stockholders. So it reduces the bank's retained earnings, and also to keep the bank capital constant, but increase the bank's assets by acquiring new funds. So that's how you can reduce the amount of bank capital. To raise the amount of capital relative to assets, what to do? What has to be done? Raise capital for the bank by having it issue its equity, by reducing the bank's dividends to shareholders, which would help in increasing the retained earnings. Then it can put into its capital account. And also the third way, to keep the capital at the same level, but reduce the bank's assets by making fewer loans. It's just the opposite of when you reduce the amount of capital. How to manage the credit risk, right? It's a risk that arises when borrowers actually default. They default in repaying the loans. And the concepts of adverse selection and moral hazards, right, which we've explained earlier, it explains or it also provides a framework for understanding the principles that any financial institutions have to follow in order to reduce the credit risk and make successful loans. So we go once more explain adverse selection. It happens when the potential borrowers who are most likely to produce an undesirable outcome, right? Undesirable outcome because they end up buying something which is not the right, make a wrong choice. They are the ones who most actively seek out for loan, and they are most likely to be selected. And what happens? They end up buying something which is not, which is the wrong selection. So that's where the problem comes up. The second thing comes up is moral hazard, which is the risk that borrower might engage in activities which are undesirable, immoral from the lender's point of view. Okay, because they make it less likely that the loan will be paid back. So when they involve into these undesirable activities, the probability that the loan will be paid back reduces. So the attempts of all the financial institutions to solve these problems, right? It actually helps to explain. There are a number of principles for managing credit risk, right? So there are principles which the banks can actually, or any other financial institutions can actually follow, which would help in addressing this problem, credit risk problem. One is screening and monitoring the potential borrowers. Specialization in lending, there should be mechanism. which would deal only with lending of some money. Enforcement of restrictive covenants. There should be certain restrictive terms and conditions under which the borrowers can get that money, get that loan. To ensure long-term customer relationships, that needs to be there. If you have a long-term customer relationship, customers will actually make it a point that they repay the money so that they can get loans again. To have collateral and some compensating balances. Why? Because if the customers fail to repay the loan, that collateral belongs to the financial institutions. And credit rationing. Credit rationing is where it's a limitation, the limitation put by the lenders of the supply of additional credit to borrowers who actually demand fund, even if the borrowers are willing to pay higher rate of interest, but the lenders actually put a limit how much credit can be given, right? And the last comes up is loan commitment arrangements. So there has to be some sort of commitment, some sort of paperwork, some sort which has to be there, where which the borrowers have to sign it to make that commitment when they're taking loans. So, right, let's go into the details of it, all these points. Screening good from bad credit risk, right? Adverse selection in loan market, it requires that the banks actually screen out the bad credit risk from the good ones, right? So the loans are profitable to the bank. They need to what they need to have reliable information, complete information about their borrowers, prospective borrowers, right? Which, and then proper screening, proper information, all these proper information collection will help in actually prevent minimizing this risk. Specializing in lending to particular firms. So firms actually specializes in lending to local firms or to firms in particular industries, right? So there are two options. What does this mean? The first option is, it means that the bank is not diversifying its portfolio of loans and thus exposing to more risk because they're giving to local firms, right? Or a firm for particular industries only limiting themselves, right? So that's there. And the second option that comes up is such sort of specialization makes perfect sense. Makes sense in the sense that they are not looking out for multiple prospective lenders, and it's difficult to manage. If they're concentrating on one area, it's easy to manage, easy to monitor. Third point, as we said, monitoring and enforcement of respective covenants. So once the loan is made, the borrower has an incentive to go for some risky activities, right? So where it becomes very difficult for the loan to be paid off. So what the bank has to do is, bank has to make some clauses when that loan contracts, right? Which the borrowers sign, which prevents the borrowers from engaging in these risky activities, right? Fourth is, as we said, to ensure a long-term relationship with your loan customers, right? So, which actually, what happens is, like the balances in the checking and savings accounts tell the banker, like the credit worthiness of the potential borrower, that how, whether they are monetarily solvent or not, and also at what time of the year the borrower has a strong need for cash, and they can actually have a check and balance, they can say. And long-term relationships benefit both, not just the bank as well as the customers, right? So when you have a good relationship with a firm has a good relationship with the bank, so it's very easy to get loans at a low rate of interest, right? So, because the bank can very easily determine if the prospective borrower is a good credit or not, if you already have a good relationship, right? So, and you already have taken loans, so you have a good previous relation from your previous relationship. It's easy. Okay. Requiring collateral and compensating balances. Now, collateral is a property promised to the lender as compensation if the borrower defaults, right? So that actually lessens the adverse selection. If the borrower defaults on the loan, then what happens? The bank can actually sell that collateral and then use it to make up for the loss of the loan, right? So One particular form of collateral required when a bank makes a commercial loan is called compensating balances. Compensating balances, the firm receiving a loan must have to keep a required minimum amount of funds in a checking account at the bank. Okay, so have to keep it. They cannot take the full amount. They cannot totally take the full amount of the fund. A certain amount has to be kept in the account, so that's and then use it. Sixth is the rationing, credit or credit rationing. So it's a way where successful banks actually deal with adverse selection and moral hazards. So whereby the banks actually refuse to make loans, even though the borrowers are willing to pay the interest rate that is stated, or even at a higher rate. So credit rationing actually takes two forms, right? First case, it occurs when a bank refuses to make a loan of any amount to a borrower, even if the borrower is willing to pay a higher interest. And secondly is when the bank is willing to pay a more but restricts the size of the loan than what the borrower would want. One is not giving, even if the borrower is willing to pay high interest. Second, bank will give, but reducing the size of the loan, not what the borrower would want, less. Okay. Then seventh comes up is loan commitment arrangements. So banks also create some long-term relationships and gather informations by using loan commitments to commercial customers. So, what is loan commitment? It is a commitment by a bank for a specified future period of time to provide a firm with loans up to a given amount at an interest that is tied at some in market rate of interest. Okay, so what is the advantage? The advantage for the firm is that it has a source of credit when it needs it, so whenever it needs. And for the bank it is an advantage. Why? The loan commitment, what happens, it promotes a long term relationship, because the banks will get returns from that loans for a long term, which is in turn helps in facilitating information collection. Okay. So, off balance sheet activities. What are them? What are these off balance sheet activities? One is loan sales, the secondary loan participation, fee income from foreign exchange trades for customers, servicing mortgage-backed securities, guarantees of debt, backup lines of credit, trading activities and risk management techniques, financing futures and options, foreign exchange trading, interest rate swaps. But these are quite risky, right? Risky because we are talking of secondary market, which is secondary market is always risk, and then we are talking of foreign uh, some other countries coming to play when we have a foreign exchange coming into play. So it's two countries coming into play. So then it also becomes risky, right? Because exchange rate can fluctuate, and valuation of currency fluctuates, and so it affects our home currency also. Okay, this is a question for you all. You need to find out the answer for this. Okay. Roche traders. Now, to highlight the problems that some of these off-balance activities generate, like what we said. So we can actually, these are some of the two devastating results, incidents that has happened. One was in Bearings, where Nick Lesson engaged in the speculative trades on the Nokia, and generated 1.3 billion in losses over a 3-year period. So, and which led to the closure of Bearings. And the next is at the Wire Bank, where what happened is Iguchi racked up $1.1 billion in losses. And when he actually fessed up, so bank decided to hide this from the regulators. And so bank ended up eventually finding $340 million and barred from all the US operations. So these are some of the examples of what happens because of these off-balance sheet activities. So how to measure the bank performance? Like bank performance is like for banks, there are three things you have to look into: the operating income, operating expenses, and the net operating income. It's very much different from when we look into a manufacturing firm's income statement. These are the income statement of bank. We look into this, right? Operating income, operating expenses, and net operating income. So this is example, bank's operating statement. See, operating income, operating expenses, and the net operating income. Okay. So the recent trends in bank performance, right? So one, we know that it's a return on assets, which is net profits by assets. ROE, return on equity, that is net profits by equity capital. And when we talk of net interest margin, NIM, which is interest income minus interest expenses by assets. So you can see the calculation, bank's performance, right? So as like any other firm, ratio analysis is also useful to measure performance and compare performance amongst banks, right? So see this is all the calculations that has been done and for the years, right? We come to the third topic, which is economic analysis of financial regulation. Asymmetric information as a rationale for financial regulation, right? Now, why do we need to have financial regulation? Because of this problem. So banks panic and the need for deposit insurance is required. So the one is FDIC, where short circuit to bank failures and contagion effect, and payoff method, purchase and assumption method. So these are some of the methods that we have, which helps in solving this problem, and it's more costly for the FDIC. And the other form of government safety nets is lending from the central bank to the troubled institutions, so lender of last resort, right? So government safety net is where we talk of moral hazards, where depositors do not impose discipline of marketplace. That's where problem comes out. Financial institutions have an incentive to take greater risk, so you end up moral hazard. Now, adverse selection, what happens? Risk lovers find bank attractive, and depositors have little reason to monitor financial institutions. So then they end up taking money from or going for transaction, buying securities or depositing money in financial institutions which do not, which are not, do not have good reputation in the market, right? Concept of too big to fail. Now, what happens is government provides guarantees of repayment to large uninsured creditors of the of the largest financial institutions, even when they are not entitled to this guarantee, right? So why? Because they feel that these big financial institutions, like they will not fail. That's why too big to fail. So they uses the purchase and assumption method, which increases the moral hazard incentives for big banks. Financial consolidation and the government safety net. So larger and more complex financial organizations face challenged regulation, right? So they have it, and which increases the too big to fail problem. Like that's why they have the problem. So extends safety nets to new activities, which means what? In whereby they increase incentives for the risk taking in these areas, right? That's what has happened during the global financial crisis period. Okay. Restrictions on asset holdings. Attempts to restrict financial institutions from too much risk taking. How? Bank regulations which promote diversification. There has to be diversification of your assets, prohibits holding of common stock, right? Capital requirements, there has to be a minimum leverage ratio for banks. Basel Accord, we have discussed earlier, which is a risk-based capital requirements. Basel Accord is where you can monitor your if you're investing in foreign assets, or if you have your banks, you have a foreign your subsidiary branch there, so performance monitoring, right? That comes up, and regulatory arbitrage, right? Arbitrage, we know, is simultaneous buying and selling of assets in different markets, provided the buyers and sellers, they do not have the right complete information. Capital requirements, right? Government imposed capital requirements. That's another way of minimizing moral hazards. So there are two forms, right? Based on the leverage ratio, the amount of capital divided by the bank's total assets can be classified as capitalized. A bank's leverage ratio, as well as a bank's leverage ratio must exceed 5%. A lower leverage ratio, especially one below 3%, it will result in increased regulatory restrictions on the bank, right? And the second way is risk-based capital requirements. So next comes up is financial supervision, where you're chartering and examination. Chartering means screening of all the proposals to open new financial institutions, right? To prevent adverse selection. So just have a proper screening to see whether it can be allowed or not. Examinations, that is, can be scheduled or unscheduled to monitor the capital requirements and restrictions on asset holding to prevent moral hazards, right? How it's been used. So these are things that comes up here is capital adequacy. These are things you need to check: asset quality, the management, earnings, liquidity, sensitivity to market risk, right? And also filling periodic call reports. Like you need to fill in those reports, right? How do you assess the risk management? Greater emphasis on evaluating soundness of management process for controlling risk, right? Greater assessment emphasis has to be given on evaluating. So, the Trading Activities Manual of 1994 of Risk Management Rating, they are based on these criteria: quality of oversight provided, adequacy of policies and limits for all risky activities, quality of risk measurements and monitoring system, adequacy of internal controls. And also where we have interest rate risk limits, internal policies and procedures, internal management and monitoring, implementation of stress testing, value at risk, disclosure requirements. These are requirements which would help to abide by the standard accounting principles and also to disclose a wide range of information, right? So the Basel II Accord and the Securities and Exchange Commission, they have put a emphasis on disclosure requirements, right? We also have Sarbanes-Oxley Act of 2002, which established the Public Company Accounting Oversight Board. We also have something called mark-to-market or fair value accounting, like the value of the assets should be based on the market value. Consumer protection. Consumer Protection Act of where we have 1969, which is Truth in Lending Act, Fair Credit Billing Act. We have Equal Credit Opportunity Act, which was in 1974, which extended to 1976, Community Reinvestment Act. Okay, and also we have the subprime mortgage crisis, which illustrated the need for greater consumer protection. That created it, right? Restrictions on competition, right? Justified as increased competition can also increase moral hazard incentives to take more risk, right? When competition happens, then what happens? You would want to go on and actually start taking more invest in riskier projects, and then it becomes a problem. So what we have is branching restrictions, which was eliminated in 1994, Glass-Steagall Act, which was repeated in 1999. There are some disadvantages where higher consumer charges and decreased efficiency. Okay. Next comes up is macroprudential and microprudential supervision. Before we had the global financial crisis, all the regulatory authorities, they were actually involved or engaged to a great extent to microprudential supervision. What is it? It's basically where you focus on the safety and soundness of individual financial institutions. Now, after the global financial crisis, it was felt that there's a need for macroprudential supervision, which talks of the safety and soundness of the financial system as a whole. Okay, so see this. This is major financial legislations in US. That's what we have. The same thing. This is the bank failures in the United States from 1934 to 2013, right? This table which we have. 1980s savings and loan and banking crisis. Financial innovation and new financial instruments, what happened that increased the risk taking. So increased deposit insurance also led to increased moral hazards. Deregulation happened. So where we had the Depository Institutions Deregulation and Monetary Control Act, Depository Institutions Act of 1982, right? We also had savings and loan bailout, right? Financial Institution Reform, Recovery and Enforcement Act of 1989. So we where Financial Institution Reform and Regulatory and Enforcement Act of 1989 we also had Federal Deposit Insurance Corporation and Improvement Act of 1991, which were where the cost of bailout was approximately 150 billion dollars or 3% of GDP. So what you see is why I'm showing you about US is that's the most developed nation in the world, and look at their economy situation, how it has actually failed, right? Problems that came up. Now the bank. Let's go to the banking crisis throughout the worldwide, right? Deja vu, that is all over again. That it happened, right? But deposit insurance is not to blame for some of these banking crises. The common feature of these crises is the existence of a government safety net where government stands ready to bail out for all the troubled financial institutions. That is government safety net. Government is there to any financial institutions that is there is having trouble, government is there, right? So that's where the problem came up. See this, the graph which shows about the financial crisis throughout the world where it happened. This is the example where we have the table again, country-wise. Okay, next comes up, next topic is structure and competition of a banking industry. All right, so evolution of the banking industry. Now, financial innovation is actually driven by the desire to earn profits. That's why innovation happens. A change in the any change in the financial environment will actually result for a search by the financial institutions for some innovations which would be actually more profitable, right? When you change the financial environment, what will happen? The financial institutions start looking for new ways how they could earn profits. So these are basically because there is change in the demand conditions, so respond to that, to respond to the change in supply conditions, and also avoidance of regulations, to avoid all sorts of regulations. Let's talk of the historical development of the banking system. Now, banks have been around since the first currency was formed, right? So in the early days of ancient empires, what was happening? Temples were considered to be the safest place, right? To keep all these valuable commodities because it's God, the gods are there. So that's the way gods would protect, right? And so the first bank that we have is the first bank which was built by the Romans, right? They took banking out of the temples. The first bank was called the Bank of Venice, which was established in 1157 to finance the monarchs in their wars. Then we have the what we have when we talk of the evolution of the bank. Then we have the goldsmith. Goldsmith, what happens is he takes special precautions against theft of gold and jewelry. And so what happens in return, the goldsmith starts charging something for taking care of the money and the valuables, right? And the goldsmith's receipt, they issue the receipts that actually became like it was like checks as a medium of exchange and a means of payment. Moneylenders. Now Goldsmith started advancing the coins on loan charging interest. So he started becoming from actually keeping gold and jewelry, started advancing loans. So it became money lenders. So he became a banker who started performing two functions, that is, accepting deposits and advancing loans. Then came up the actual establishment of the banking system. So the modern banking system started in Venice in 1587, and in the same year, what we have is we have the Banco di Rialto was established. So people could deposit even their gold and silver items in this bank, for which the bank issued receipts, and these receipts were used as currency notes, right? First bank in US was set up in the year 1782 in Philadelphia. In England, the first bank came up in 1825. Today, what has happened is banks serve many other purposes, such as giving credit cards, foreign currency to people who travel abroad. Banks also provide us with a locker facility where we can keep our valuable jewelry, right? So in the modern banking system, what we have is when the bank makes loans, it does not take other people's deposits and it and lend them out, right? So when it make loans, what happens? It simply types into the account that the borrower owes it a sum of money, right? That is the bank's assets. It just does not give it. The money is not actually given. It's just transferred in papers, right? So, in the process of depositing money in the bank, lending it, getting interest on the deposited money, the whole banking system, that's how it works, right? Money is deposited and then lending to someone else. It's just a pay, it's money as such is not given, transfer, it's on paper that's being done. And that's how the banking system is working. So what are the channels of banking system? We have internet banking, which is also, as we know, is a net banking, right? Net banking system that we have, which is also called e-banking, as we know, online banking we know, and we also have something called virtual banking, where we basically do not have to go today to any place, right? So that's what comes up. And it actually it offers the fastest and cheapest mode of banking where the customer uses internet facility today. We don't have to go to bank. Core banking, which is also known as computerized banking, where the branches of any bank, they're linked to a core computer so that data is accessible anywhere anytime. So what happens, you can deposit money in, you don't have to go to your branch and deposit the money. You can deposit money to any of the branches, and you can withdraw money from any of the branches of the same bank, right? So there, because the computers are all linked to a core computer called the server. Mobile phone banking, so what happens, there's no financial limit for transactions in a day. So it's actually, it refers to the actual bank transactions which is done through mobile phones. Intermediate payment services, that is IMPS, right, which is developed by the National Payment Corporation. In India, we have this, which offers an instant 24 bar 7 services to facilitate use of phones as a channel for accessing bank accounts and execute interbank fund transfers. Telebanking, which refers to telephone-based banking. So here, what's happening? There are no transactions are allowed in telebanking. So it's a call center-based banking. Okay. We have ATM, that is automated teller machine, which allows us to withdraw money from our account anytime, anywhere, right? Pre-deposit, online payment of bills, mobile recharge, fund transfers. We have some confidential PIN number, that is personal identification number, to activate the ATM. We have debit and credit cards also, which is known as plastic money. So debit card is it's linked to a specific bank account and can be used to operate only that account. Whereas credit card, what happens? They get a monthly bill for the transactions that they make. We also have Visa or Mastercard. Visa, there are two international card service providers. One is that is global payment gateways. Okay, so all transactions put through various debit or credit cards, and they are coordinated and serviced by these two companies. Types of banks that we have, first comes up is savings bank. Savings bank is a financial institution whose main purpose is to accept savings deposit and paying interest on those deposits. Okay, and they're basically set up to encourage low-income people to save money and have access to financial services. Now, financial savings bank was established in the year 1765. Okay, in Brumont, but the idea was suggested in England, that it came from England as early as 1697. So today we are, and even in Germany, in Hamburg, you have Savings Bank. It came up in 1778. Next is direct banks. It's a bank without any branch network that offers its service remotely. Right? It does not have any branch network. It How does it go? It works through online banking and telephone banking. So it also have you can also direct bank also have provide access via ATMs, mobile, mail, right? So one of the first fully functional direct bank was the First Direct, right? First Direct, which was formed in October 1989, right, in UK. And the commercialization of the internet was the biggest force for creation of full direct banking models. Private banks are where when we talk about it's different from the retail banking and savings banking, right? So they often advise and perform all financial and banking services for families, right? So first private bank was in Venice, which was managing the personal finance of wealthy families, right? And it has a long tradition of their own, right? So, and started its business since 1672. Next is commercial banks. It's also a type of financial institution which provides services like accepting deposits, making business loans, and offering basic investment products. So basically, it was established with the object to help businessmen, right? And it was first time it came up was in 1924 by the local businessmen in Oglethorpe country, right, with the main idea of serving the financial needs of the citizens and businesses of that area. Community bank, it's a depository institution that is totally owned locally. It's locally owned and operated, right? That's why community within that area. So which actually looks after the needs of the businesses and the families where the bank holds branches and offices. So it came up the first time in 1945, and then where we had Hunton Park Bank, which later changed its name to Community and to underscore the bank's commitment to the communities it served. Right. Online banks. Online banks, they operate totally online, right? There are no physical branch available where you can visit, right? So online banking started in 1980s in New York, right? And parallelly also it came to UK. So the UK's first home online banking service is known as HomeLink, which was set up by the Bank of Scotland for customers. Now comes up mutual banks. Mutual savings banks, it's a financial institution which is controlled by the central or the regional government, right, without capital stock, that is owned by its members who subscribe to a common fund, like those who are investing money, right, pool in money and invest there in that fund, and invest in different portfolios of diversifying risk, right? And the Reverend Henry Duncan in 1810 in Ruthvel, Scotland, right? He started it. He established a small bank in order to encourage his working class, and the banks were started by philanthropists who took on the positions of the savings banks trustees, managers, and directors. Central, and that's how they were looking for it. So it was their money which was there, these people's money, and so the members are actually owning it, right? It's totally owned by the members. Central banks, We know the central bank, every country has their own central bank, which they manage the monetary system for a government, right? So in US, it's a federal bank, Federal Reserve Bank. Here in Bhutan, we have a RMA. In India, it's RBI. But the purpose is same. It's for managing the economic activity and supervising all other banks in the country, right? The first central bank that came up was in Sweden, Swedish Riksbank, which was established in 1668 as a joint stock bank, right? Uh, After a few decades later, in 1694, the very famous one of the famous central bank of that time came out. That was Bank of England, right, which was also started as a joint stock company to purchase government debt. Ethical banks. What is ethical bank? Ethical bank is also called a social, alternative, civic, or sustainable bank, which is basically concerned with the social and environmental impacts of the investment that it makes, the loans that it makes, right? So the cooperative movement, new social movements from 1960s have developed a practice of ethical banking. Investment banks. Investment banks help businesses to work in financial markets. If a business wants to go to public to sell or sell debt to its investors, they will often use an investment bank. Investment bank came up when did it come up? In the late 90s and early 20s, mainly in the US. Retail banks. Retail banks are where what happens? Your checking and savings account are held at a retail bank, which focuses on customers, right? These banks actually gives us credit cards, offered loans, and they are the ones with numerous branch locations in populated areas, right? So in the 18th century, there were several initiatives were taken to carry out this task. And in 1810, as we said, Ruthwell Savings Bank was established in Scotland by Reverend Henry Duncan. So that's when it first came out. Okay. We go to the next part, that is a topic that is structure of the banking system anywhere around the world. Now, the financial system of any economy is expected to support the changes that is happening in the economy, right? And banking sector has been affected to a great extent by the liberalization policy. Another factor is also the changes in the technology, right, which has also affected the structural change in the banking industry. And this structural change in this in the banking sector can be actually highlighted with the fact that there is increased participation of in number of international financial players in any country's financial system, as well as the financial players of that nation, which actually shows a tendency towards becoming global players. So what's happening in that any financial system of a country is being actually today there has been interaction and involvement, not just by the financial institution, the financial players of the country, but also international financial players are also there. So what does that mean? There's an interaction happening. So every fund, the banking sector of any country, so today they're becoming, they're not no more stuck within their own country, so they are becoming global. Interactions happening. And banking industry is actually, we know that's the backbone of the nation, right? It has to live up to meet the economic needs and also to provide a protective backdrop for all the economic entities, right? By actually assuming that certain inherent risk in the financial system, they have to given the certain risk which is there, so they have to they have to live up to the expectations of how to meet the economic needs and also to protect the economic entities, right? And also what we have is the change, besides the change in the overall structure that we said, the structure of every entity within the banking industry has also undergone these changes. Not just the entire industry as a whole, but all the individual, all everyone who part of that industry also has undergone these changes in order to meet these economic and the risk taking needs, economic needs and the risk taking needs, right? There has been also concern which is expressed by the international financial community or where they felt there is a need to strengthen the banking industry to support the high growth expectation of the economy. And quite often it has been observed that the changing market requirements, if it is not being considered by the financial system of an economy, has not reflected in the expected growth rates of the productive economy. So if the financial system actually neglects it, the market requirements, then it is not taken into consideration when we talk of the growth rates and the of any productive economy. So the banking structure is expected to support the economic is expected to be strong enough to support the economic growth and also contribute towards the long-term progress of the nation, right? So which is why they need to be flexible enough to allow for economic expansion and also to provide stability of the financial sector of that economy, right? So the consistent trend of the economic policies by their respective governments is hence considered essential in the formation of the banking structure, right? So the economic policies and which is by the government, so that actually helps in determining the formation of the banking sector. So if you talk of the banking sector structure, that can be mapped through the functions that the banks perform, which is associated with the economy, right? The main role of the central bank is to govern other banking structures of the economy. The central bank monitors and controls the entire banking system of an economy. It also acts as a banker to the government and maintains the deposits and other activities of other banks that have been allowed to operate in that economy. It's also responsible for monetary and credit policies, manages the government debt requirements, promotes financial inclusion, encourages development activities in the economy, monitors and maintains the money value, right, in versus other global currencies. So when we talk on a foreign exchange, right, it also exercises credit control and control over money supply in the economy, right? So besides the primary function of accepting deposits and lending through loans and advances, banks also have a variety of other services, such as providing safety custody for the valuable customers, provide foreign exchange, to help in transfer of money, to provide guarantees, to give letters of credit, right, when they stand as guarantor on behalf of their depositors. Like it could be like who's either importer or an exporter, like when you have business going on. So banks stand as your guarantor. And banking operations, it involves several types of risk. We know this. Credit risk happens, liquidity risk, market risk, operational risk, system risk. The effectiveness of the risk management by the bank, it depends on the technology that is there, technology support, the amount of capital adequacy, the tools and techniques that is there, the audit and supervision, and supportive legal environment. All this actually tells us how effectively banks can control the risk, right? How they can manage. The loan policies followed, interest rates which is determined, asset acquisition and management, internal credit rating process, risk tolerance levels, fixed for investment purposes, right? These are some of the business strategies which is adopted by the banks. And these are the banking practices that actually reveal the approach of a bank to its risk management practices. So what are the different types of practices that the banks have? That tells us how well is the bank's structure, effective operating structure, and what is their approach in tackling these risk management. Like what are their practices? And what sort of practices do they have to tackle this issue of risk management? Okay, so next is competition in the banking sector. Now there is competition everywhere. So competition amongst the commercial and investment banks, they are actually influenced by a different set of factors. Some of the common factors are size, quality, service quality, and regulatory obligations. So the ability of the bank to actually sustain these competitive forces, it depends on the operational structure of the bank, the product innovation, their innovation, the skill, technology support, the cost of services, the quality of service, the skills of human resource at the bank. Okay. So for an investment bank, the competitive edge, it depends on their investment performance, the innovation in their services, cost of services, number of clients that they handle, confidence in the bank, and the reputation of the banks. So given this competitive environment, ability of the bank to foresee the changes and their flexibility to adapt to these changing conditions will give them an upper edge, right? So this change and the change factors that have to be initiated by the bank to have an impact on its operations are needs of how do they go it with this based on the needs of their customers, their knowledge level, the technological changes, the regulatory changes, new competitors, new services, quality of human resources, and marketing efforts. So how the changes that their banks will undergo will, okay, uh, are which to have an impact on their operations. So these are the changes like changes customers, new knowledge level, the technological changes coming up, changes in regulatory system, new competitors, new services, human resources quality, the marketing efforts. So these are the things where changes have to come about, right? So what we have is now when we had the global financial crisis, that actually reignited the interest of policymakers and academics in the banking competition, right? They started taking fresh interest in the banking sector and the role of the state in competition policies. That is, the role of state is the policies and laws that affect the extent to which banks compete, right? And some believe that this increase in competition and financial innovation in markets, where we're talking of subprime lending, does actually resulted to this financial crisis. And there are others who worry that the crisis and the government support of the largest bank increased that actually increased the banking concentration. Large banks started dominating, that reduced competition and the access to finance, and which actually resulted in future instability, which as a result of this moral hazard problems, which is associated with too big to fail institutions. Big institutions will not fail, and then what happens if they are actually into crisis? The banks actually, government actually protecting them, supporting them, right? That is actually so the big banks, they have been actually dominating, right, the market. So as in other industries, same thing in a competition in the banking sector is desirable. It is needed also. Why? For efficiency and maximization of social welfare, right? But due to its roles and functions, there are some properties that actually distinguish it from other industries. So it's important to not only make sure that the banking sector is competitive and efficient, but it is also stable. So competitive and efficient is not enough. It should be also stable. Banking sector fails means what? There will be an economic failure, right? Economic crunch will happen. So financial innovation. So what is it? It's an innovation is a result for search for profits. So that's where when the banks actually look for profits. So when can that happen? Response to change in demands. Major change is huge increase in interest rate which started in 1960s. So example is where we had financial derivatives, adjustable rate mortgages. Response to change in supply. Major change is improvement in computer technology, which helps in increasing ability to collect information, lowers the transaction cost, right? So some of the examples are bank credit and debit cards, electronic banking facilities, junk bonds, commercial paper market, securitization, right? Okay, responses to changes in demand conditions, that is interest rate volatility, adjustable rate mortgages. So where we have flexible interest rates, which keeps the interest profits high when rates are high. Lower initial interest rates make them attractive to home buyers, right? When you initial interest rate is low, you have people more households are more likely to buy it. Financial derivatives, so where the ability to hedge interest rate risk, you can do it. And payoffs are linked to previously issued securities. It's totally linked off to the what has been issued, the already securities which is issued. So the payoffs are totally decided based on those securities. Okay. Responses to changes in supply conditions, that is information technology. We said bank credit and debit cards, improve technology owners, lowers the transaction cost. Electronic banking, we have ATM, home banking, ABM, virtual banking, junk bonds, commercial paper market, securitization. Avoidance of existing regulations. Regulations behind financial innovation, one is reserve requirements, right? So tax on deposits, that is I into interest rate, I into R, right? So as I increases, loophole mine to escape the reserve. R stands for reserve requirement. I is the interest. So loophole mine to escape reserve requirement tax and deposit rate ceilings. Right? Example is money market mutual funds, sweep accounts. Okay. We come to the next aspect of that is shadow banking system. What is it? It's a group of financial intermediaries who facilitate the creation of credit process throughout the global financial system, but whose members are not subjected to regulatory oversights. So the shadow banking system is also called as unregulated activities by regulated institutions. Okay. Examples of intermediaries not subject to regulation, these are hedge funds, unlisted derivatives, and other unlisted instruments. Whereas examples of unregulated activities by regulated institutions include credit default swaps. So in shadow banking, they have lenders, brokers, and other credit intermediaries who fall outside the area of the traditional regulated banking. It's generally unregulated and not subject to the same kinds of risk, liquidity, and capital requirements as in traditional banks. It plays an important role in the expansion of housing credit, right? Which ran up to the 2018 financial crisis. So it played a very important role. But today it has grown in size and largely escaped government oversight even since then, right? So shadow banking has escaped regulation primarily why? Primarily because unlike traditional bank and credit unions, these institutions do not accept traditional deposits. How did it come up? It came up it arose as innovators in financial markets who were able to finance lending for real estate and other purpose, but who did not face the normal regulatory oversight and rules regarding capital reserves and liquidity that are required for traditional lenders in order to help prevent bank failures, run on banks, and financial crisis. So it came from them, these who were actually able to finance lending for real estate and other purpose, but who do not go face any normal regulatory oversight. So as a result of this, many of the institutions and instruments have been able to pursue higher market credit, higher liquidity risk in their lending, and do not have capital requirements and commensurate with those risks. Okay, so many of these shadow banking institutions have heavily involved in lending related to the boom in the which led in the subprime mortgage lending and loan securitization in the early 2000s. After the subprime meltdown in 2008, the activities of the shadow banking system came under increasing scrutiny because of their role in overextension of credit. Right? They were giving more. There's no limitation. Overextension of credit and also the systematic risk in the financial system, which resulted in the financial crisis. So it's a blanket term which is helped to describe financial activities that take place among non-bank financial institutions, which are outside the scope of central bank regulators, which could be, and these could be Investment banks, mortgage lenders, money market funds, insurance companies, hedge funds, private equity funds, payday lenders, right? All of which are a significant and growing source of credit in the economy. Now, despite that scrutiny that came up in the shadow banking institutions due to the financial crisis, the sector has grown significantly. And in 2017, May 2017, Switzerland-based Financial Stability Board released a report regarding uh, the extent of global non-bank financing. And what they found out that the non-bank financial assets has actually risen from $89 trillion in 2014 to $92 trillion in 2015. And there was another report on more narrow measure in the report. And that report also indicates that shadow banking activity that may give a rise to financial stability, that risk, the financial stability risk actually increased from it increased it grew up to 34 trillion in 2015. That is up to 3.2% from the prior year. They've increased by 3.2%, and that excludes data from China. Okay, excluding China. Now, most of these activities centers around the creation of collateralized loans and repurchase agreements. They are used for short-term lending between non-banking institutions and broker dealers, right? Short-term lending which happens. So avoidance of regulations, loophole mining, right? Reserve requirements act as a tax on deposits. It's just where you have a sweep account. Restrictions on interest paid on deposits led to disintermediation, that is money market mutual funds. So decline in banks as a source of financing, it started declining this worldwide. Right? Decline in the traditional banking. So decline in cost advantages in acquiring funds. So why did it happen? The main thing, rising inflation, which led to rising interest and disintermediation. Now, low cost source of funds, checkable deposits declined in importance. Decline in income advantages on uses of funds, that is assets. Information technology has decreased need for banks to finance short-term credit needs or to issue loans. Information technology has also lowered transaction cost for other financial institutions, thereby increasing competition. And as a source of funds for borrowers, market share has fallen. Share of total financial intermediary assets has fallen. No decline in the overall productivity, but there's increase in income from off-balance sheet activities. So, how is the banks respond? Expand into newer and riskier areas of lending, that is commercial real estate loans, leveraged buyouts, corporate takeovers. Pursue off-balance sheet activities, that is non-interest income, concerns about risk. So see this is the structure of the commercial banking industry as of 2002. All right. Bank consolidation and nationwide banking. The number of banks have declined over the last 25 years. With bank failures on consolidation, that's been deregulation and economies of scale and scope of information technology. So results maybe not only a small number of banks, but a shift of assets to much larger banks, right? So because people are now shifting to larger banks, so small banks have gone down. Benefits and costs of bank consolidation. Benefits, if we say, it results in increase in competition, which driving out the inefficient banks out of business. So lesser number of banks today. Some banks are getting merged. So increase efficiency also from economies of scale and scope. There's low probability of bank failure from more diversified portfolios. The cost is elimination of community banks have led to less lending to small businesses, and banks are expanding into new areas may take increased risk and failure also can happen. So there are three basic world frameworks. One is universal banking. There's no separation between banking and securities industries. British style universal banking, which may engage in security underwriting. Separate legal subsidiaries are common. Banking equities of commercial firms are less common there. Few combinations of banking and insurance firms. And some legal separations where it's allowed to hold substantial equity stakes in commercial firms, but holding companies are illegal. How asymmetric information explains banking regulation. We spoke about government safety net and deposit insurance, which prevents banks to run due to asymmetric information. Depositors can't tell good from bad banks, creates moral hazard incentives for banks to take on too much risk, creates adverse selection problem of crooks and risk takers wanting to control banks. Too big to fail, increase moral hazards incentives for big banks. That's what happens when government starts protecting, right, these banks. Restrictions on asset holdings. It reduces moral hazards of too much of risk taking. Bank capital requirements reduces moral hazards. Banks have to have more to lose when they have more capital, right? Higher capital means more collateral for FDIC. Bank supervision, that is chartering and examination, reduces adverse selection problem of risk takers or crooks owning banks, right? You can do a proper examine and select whom you want to actually give loans, right? And that also helps in reducing adverse selection, reduces moral hazard by preventing risky activities because there's scrutinization happening, examination. It's a new trend, which is assessment of risk management. It's done today. Disclosure requirements come on, where better information helps in reducing the asymmetric information problem. Consumer protection, where we have standardized interest rates, which prevents discrimination. Restrictions on competitions to reduce risk taking. Branching restrictions, right? Not so many branches are coming up, so there's a restriction. So separation of banking and securities industries in the past, right? International banking regulation. Bank regulation abroad similar to ours, the national within the country, it has the same particular problem of regulating international banking. So it's needed. Now, when we talk of international banking, the entire banking industry was transformed in 1970s. Until then, most banks were only concentrated in their home markets, considering themselves as domestic institutions that handled all financial business. But with the expansion of international networks, the banking sector today, it occupies a very important position in the global economy because it has an access to the capital, the technology, its technological capabilities, and the international network to facilitate these activities. Banks today monitor the business sector through the evaluation, pricing, and credit granting functions. So, in this context, what happens? The operations of an international trade of services that have as a consequence either the creation or management of financial means or the transport of capital from surplus units of the countries to another, mediation in the frame of national financial system. They're called today called the international banking activity. Today it's they are involved in the not just within the banking system within the country, but they're actually having access to the international system also. Like they can operate, they have access to all the information. And the banks are actually interlinked, right? So today it's called an international banking activity. Now, banking transactions happening today across national boundaries, right? And so they are undertaking international lending. So all claims of domestic bank offices on foreign residents, claims of foreign bank offices on local residents, claims of domestic bank offices on domestic residents in foreign currency, just taken care of all these things. Services that is offered, international banks do everything domestic banks do. They arrange for trade financing, arrange for foreign reserve, foreign exchange, offer hedging for services for foreign currency receivables and payables through forward and options contract. They offer international banking services where it's allowed, like borrow or lend in euro currency market, and underwrite also euro bonds and foreign bonds. They also provide services to those who are engaged in international trade and investment, that is risk, herring, liquidity information, right? Risk herring, that is there, risk sharing, that is actually there, risk sharing, right? Like domestic banks, also international banks accept deposits and lends. They lower transaction cost and lower information cost. In the international banking, international financial regulations can lend to innovation in banking, right? Types of international banking offices: one is correspondent bank, where banks located in different countries establish account in other bank. Okay, so they provide a mean for the bank's MNC clients to conduct business worldwide through their local bank or its contacts, and it provides income for large banks, right? Smaller foreign banks that do not do business, that don't want to do business, say in the US, will enter into a correspondent relationship with a large US bank for a fee. We did talk about this. Representative office, a small service facility which is staffed by the parent bank personnel, that is actually who are assigned to assist the MNC clients of the parent bank, their dealings with the bank's correspondents. There are no traditional credit services provided, and it looks for foreign market opportunities, and it serves as a liaison between the parent and the clients. It's useful, especially when we go for the newly emerging markets. These representative offices also assist with providing with the information about local business customs, credit evaluation of the MNC's local customers. It's useful when bank has many MNC clients in a country. Then only it's good to have a representative office. Foreign branch. The foreign branch bank, it operates like a local bank, but it is legally part of the parent, not a separate entity. So it is subject to both the banking regulations of home country as well as a foreign country, right? So what's the reason for establishing a foreign branch? It's more extensive, providing more extensive range of services, faster check clearing, larger loans. And these foreign branches, they are not subject to any reserve requirements, or in US they are not subject like the Canadian in other countries, reserve requirements or deposit insurance, and they compete with host country banks at the local level. It's also one of the popular means of internationalizing the bank operations. We also have subsidiary and affiliate bank. A subsidiary bank is a locally incorporated bank that is either wholly owned or owned in major part by foreign parents. Right? It's a bank which is partially owned but not controlled by its foreign parent. Right? And both the subsidiary and the affiliated banks operate under the banking laws of the country where they are incorporated, and they are allowed to underwrite securities. We also have offshore banking center, so where a country whose banking system is organized to permit external accounts beyond the normal scope of local economic activity. Now, the host country usually grants complete freedom uh, from host country governmental banking regulations, right? Banks operate as branches or subsidiaries of the parent bank, and the primary credit services provided in currency other than host country currency. Reasons why do we have the offshore banks? Low or no taxes, services provided for non-resident clients, few or no foreign exchange control, legal regime that upholds foreign secrecy. And IMF actually recognizes the Bahamas, Bahrain, Cayman Islands, Hong Kong, Netherlands, Antilles, Panama, Singapore as major offshore banking center. Okay. Reasons for why do we have international banking? One is low marginal cost. The knowledge with regards to management and marketing developed at home can be used abroad with low marginal cost. Knowledge advantage. The foreign bank advisor and subsidiary can actually look upon the parent bank's knowledge of personal contacts and credit investigations, and it can rely on them, can draw on that knowledge for use in that foreign market. Home nation information services. And local firms in a foreign market may be able to obtain more complete information on trade and financial markets in the multinational bank's home nation. than is obtainable from foreign domestic banks. Prestige. Very large multinational banks have high prestige, high perceived prestige, which can be attractive to new clients. Regulatory advance. Multinational banks are often not subject to the same regulations as domestic banks. Wholesale defensive strategy. Banks where banks follow their multinational customers abroad in order to avoid losing their business at home and abroad. Retail defensive strategy, where these banks also compete for retail services, which includes the traveler's check, tourist, and foreign business market. Transaction cost. The banks may be able to circumvent actually some of these government currency controls. Growth. Foreign markets may offer growth to 11 to 21 growth not found percentage, right? Not found domestically. Risk reduction, greater stability of earnings due to diversification, right? What is euro currency market? Now, before World War II, the pound served as the international transaction currency, right? So euro dollar is a dollar denominated deposit in a bank outside the US. British banks here trying to avoid the rules on the use of pounds created euro dollar market, which is LIBOR. Okay. Now, much of the international banking today is done through banking centers called euro markets. Euro currency is a time deposit in an international bank located in a country different from that country that issued the currency. So euro dollars are US dollar denominated time deposits in banks located outside United States. Euro yen are yen dominated time deposits in banks located outside of Japan. Foreign banks does not have to be located in euro. Low cost structure, reserve requirement, not required, no deposit insurance, and there's rapid growth, especially in the euro dollar market. So this is an external banking system that runs parallelly to the domestic banking system. Now, most euro currency transactions are interbank transactions in the amount of 1 billion US dollars and up, right? Banks seek deposits and make loans to other euro banks. Loan interest rate is the interbank offered rate. And interbank deposit interest rate is the interbank bid rate. Okay, one is the interbank offer rate, which is the loan interest rate, and interbank bid rate is the interbank deposit rate. Common references of rates. What do we know? We know this. These are some of the rates. LIBOR, that is London Interbank Offer Trade. PIBOR, that is Paris Interbank Offer Trade. SIBOR, Singapore Interbank Offer Trade. And new reference rate for euro today is Euribor. Okay, so rate at which interbank time deposits of dollar are offered by one prime bank to another. What is euro credit? Short to medium term loans of euro currency to corporations, banks, non-prime banks, or international organizations. And these loans are often too large for one bank to underwrite. A syndicate of banks actually share the risk of the loan. So it's adjustable rate and roll out for 3 to 6 months. On euro credits originating in London, the base rate is LIBOR plus X% based on the creditworthiness of the borrower. So this is how it's been calculated. Euro notes. These are short-term notes which is underwritten by a group of international investment banks or international commercial banks for 3 to 6 months, which are sold at a discount from face value and pay back the full face value at maturity. So they're sold at a discount from the face value at less and pay back the full face value on maturity. So interest rate usually is less than syndicated Eurobank loans, that is LIBOR plus 1/8%. Banks receive a small fee for underwriting, right? Euro commercial notes papers. Euro commercial papers are unsecured short-term promissory notes issued by corporations and banks for 1 to 6 months. It's placed directly with the public through a dealer. Like Euro commercial paper, it's typically a US dollar denominated, is often of lower quality than US commercial paper. As a result, which yields a higher. Euro commercial paper market sizes in 2006 was 635 billion, not trillion, $635 million. Right. International banks, now what are the key risks that we have? International lending risk, country-wise there can be risk, credit risk can come up because currency risk can come up, foreign exchange risk come up because we are talking of currencies of different countries, right? So it's banks of different countries, so it's not within the same nation where you have the same rules and regulations. Different nations are involved, and so risks are of diverse different types of risk. Now these are the world's largest international banks that we have and their countries. Okay, right. We go to the next topic, that is current state of financial sector in Bhutan. Now, financial sector in Bhutan has undergone a transformation where it is expected to efficiently to fulfill the role of a mediator of resources in the economy. And due to the growing competition in the financial sector, risk, profitability, and balance sheet structure management, balance sheet structure management would not only play an important role, right, in the maintaining of the macroeconomic stability, but also in the stability of financial sector in Bhutan. Financial stability as well as macroeconomic stability. So the financial sector is an important source of finance for businesses in any small country like Bhutan. So, right, Bhutan is a landlocked nation. We know that, right? Despite the fact the country's economy has witnessed a steady economic growth from of 7 to 8% annually over the past 2 decades, mainly supported by the secondary sector. But the agriculture in the agricultural sector, the growth and contribution has slowed down uh, particularly since 2000. So while the contribution of the service sector has not shown much change, that of the financial and insurance sector has improved marginally. Right. So according to the World Bank report of 2010, the country's per capita gross national income, which is one of the highest in South Asia, rose from 730 US dollars in 2000 to 1,900 US dollars in 2008. Okay, so let's look into the evolution and structure of the Bhutanese financial sector. So RMA, or the Central Bank of Bhutan, was established in 1982, right, which is in charge of regulating the financial sector and formulating the monetary policy. Today, the country has 5 banks and 2 non-banking financial institutions, right? Also, we have the Royal Securities Exchange of Bhutan, which is the country's stock exchange. Also, the National Pension and Provident Fund, which is the pension fund. These are some of the important concepts, components of the Bhutanese financial sector, right? So this is the entire structure where we have RMA, Central Bank, and then we have banks, non-bank, capital bank, pension fund. Pension fund is NPPF, capital market is Royal RCB, non-bank we have RICBL, and we also have the BIL. And we banks, we have BOB, BNB, Druk PNB, T Bank, and BDPL. Okay. So, when we look into the evolution of the major banks and the financial institutions, first comes our Bank of Bhutan, which was established in 1968 as a joint venture with Chartered Bank of India, Australia, and China, which owned 25% of the bank. So, as the public sector commercial bank with paid up capital of 2.5 billion Bhutanese neutrum and a reserve amount of same total. So it carries out the function of a central. It carried out the function of the central bank until RMA was formed. So it was formed before RMA. At that time, Bank of Bhutan was also carrying out the function of a central bank, right? And the pace of growth of the BOB was marginalized due to the non-convertibility of the local currency until 1972, when it was reconstituted under the Royal Charter of Bhutan, where the State Bank of India became a partner in capital and management with 50 shares, right? And 2008, Bank of Bhutan had a network of 226 branches, 3 extension counters, paid up capital of 400 million neutrum, that is 7.2 million US dollars. It enjoyed a complete monopoly till 1990, until 1997, when the Unit Trust of Bhutan, an undertaking of the government of Bhutan, was converted into the country's second national bank, right? And which was with the initial capital of 2.5 million neutron, which was contributed by government and the Royal Insurance Corporation of Bhutan, right? So in 1975, the country's only insurance company was set up, RICBL, which continues to enjoy a monopoly in country's insurance market. Initially it managed the provident fund of government employees, public sector companies. Today, from 2000 onwards, the NPPF was created to manage the pension and provident fund of government and public sector employees. Okay. Then comes up is Bhutan Development Finance Corporation Limited, which was set up in 1988 as a financial sector to look into the financial needs of the micro, small, and medium enterprises, with a focus of special focus on the agricultural development. Because agricultural development had not, the contribution was gone down, so it took over the administration of rural financial assistance from the RMA. So loans were granted for actually promoting the agricultural sector, for improving the farmland, acquiring livestock, meeting short-term, seasonal requirements. And some of these funding for the corporation came from ADB, for the expansion of the small, medium-sized private sector industrial development, right? So by 1991, the corporation had been privatized. So government of Bhutan today owns 85%, the remaining 13% held by 3 financial institutions, right? So today the the Bhutan Development Finance Corporation, today it's known as BDBL, Bhutan Development Bank Limited. The name got changed in 2010, right? And to develop the country's capital market, the government, with technical assistance from ADB, they set up the RACBL in 1996. The exchange is owned by 4 brokerage firms, that is Bank of Bhutan Securities Limited, Bhutan National Bank Securities Limited, Druk Securities Limited, and RICBL Securities Limited. T-Bank, we have T-Bank focuses its operations locally. Druk PNB has a 51% in stake in PNB of India, right? So overall, there have been efforts to create institutions and inject competition in the financial sector to ensure that the various socio-economic objectives are fulfilled. So it's very important to analyze the performance of these institutions to actually to make a total, in order to have a total idea about their efficiency and sustainability. In recent years, the Bhutanese financial sector has experienced some major positive changes despite being affected by the global meltdown. Tourism and hotel industries are major contributors of the economy and livelihood of the people, which witnessed a decline in the tourist arrivals while the important ferro-silicon industries suffered due to fall in prices of the ferrosilicon products in international market. And the impact of this global meltdown on tourism and steel industries, they trickle to the financial sector due to the credit exposure in these 2 sectors of more than 3 billion neutron, right? And what happened as a result as a response to this crisis, as well as to improve the operating performance, the ownership of BOB was transferred to DHI, True Holding Investment, and there were major efforts which were made to modernize the bank services by using FlexCube technology in 8 branches under the guidance of Tata Consultancy Services, right? So more advanced technology which was implemented has helped the bank to introduce some very convenient delivery channels, that is SMS banking, as well as to become the first bank in Bhutan to launch internet banking facilities, right? So now, taking into account the high rate of importance of customer satisfaction has on a bank's performance, the Bank of Bhutan regularly conducts feedback services to monitor the customer's satisfaction level. So in order to improve their services, customer service conveniences, bank today has what is called Sunday banking also has started, right? So 7-day services, right? Other than also with the introduction of ATMs, internet and mobile banking to improve their customer satisfaction level, right? So BOB also has initiated some social sector target loan schemes to act, say for instance, for catering to the educational sectors, pensioners. So it's increased their loan base, and the new technology, which is extensive branch network. It's a network switch, and the planned installation of 100 ATMs across the country has helped the bank to provide anytime, anywhere banking in the country. Bank has also implemented some new organizational structures to improve its operations, which includes the creation of zonal offices for enabling to the faster delivery of services. It's also today giving scholarships to 60 BOB employees for masters and postgraduate studies abroad for a 10-year period, right? So same thing. Similarly, Bhutan National Bank was also upgraded to FlexiCube CBS technology with a higher version. They've also introduced new delivery channels, that is SMS, internet banking, ATMs. It's hired the services of the consulting firm, that is Ernst and Young, to help in restructuring their operations, so that they are able to face the new competition in the Bhutanese financial market in a better way, right? Which has resulted with the introduction of three new commercial banks that came up, right? The RICBA has implemented a voluntary retirement scheme to make the organization more lean and in a better position to face competition from BIL, which is an insurance company which was introduced in 2009, right? So the corporation also introduced new products and introduced new policy premiums. It has the BDPL has moved its corporate offices today to a new building and obtained a license, which enables it to accept deposits and functions as a rural bank. So during the period of 2005 to 2010, the Bhutanese financial sector has seen significant changes, right? But it's too early to analyze the impact on the economy. Some of the major changes in the financial sectors in Bhutan can be is one is two new commercial banks have become operating in Bhutan, where we're increasing the competition in financial sector, right? And so, which has resulted in a more comprehensive and more innovative financial products, fair pricing of services, and cost of capital, right? So, Bhutan Development Finance Corporation, which later on changed into BDPL, right, 2010, and Druk PNB, which also started operating from 2010. So later on, it which was followed by T Bank. So all these banks actually started operating from 2010. So Bank of Bhutan being the oldest commercial bank, it has planned to connect to connect the entire country. So which has wanted to actually connect to all the branches that is there throughout the country. They want to connect to all the branches. How? Through a central server in 2008, where they installed a core banking system solution, CBS, right? So, and by 2010, all the BOB branches were connected to the central server, which actually helped customers to do bank transactions from any branches, right? So the other commercial banks in Bhutan have since been implementing core banking system, making it possible to customers to operate from any branches. Started by BOB, and then today we have for all other banks also, right? So the Royal Monetary Authority of Bhutan, that's the Central Bank of Bhutan, has implemented a central switch, which is called the Bhutan Financial Switch, which connects all the banks in Bhutan. So it provides a platform for interbank settlements on a real-time basis. It also enables customers of any of the banks to withdraw funds from any ATM. BNB had ATMs connected to central servers since its establishment only in Thimphu and Phuentsholing, while BOB had a standalone ATM in Thimphu and Phuentsholing. So currently there are several ATMs spread throughout the country which are connected through the central switch. The paid-up capital requirement for banks also increased to 300 million neutron in 2008, from 200 million, right? While the initial paid up capital was set at 200 million, with a requirement that it has raised to neutral 300 million within 3 years from the commencement of business. When BIL was established, it reduced the monopoly, of course, of the RICPL, and as a result, there has been a dramatic improvement in the insurance services and a reduction of cost related to insurance. When you have competition, the cost will go down. In 2009, the RMA, they launched the Credit Information System, CIS, which is funded by the financial institutions of Bhutan. It contains information on the borrowers of all the financial institutions and is accessible instantly to all financial institutions for a minimal fee, which it is expected that this would help in improving the quality of loans. Like when you give loans to your borrowers, you get the information, right? So it becomes easier, right? To actually, it helps in improving the quality of loans, which will also help in turn to cut down the loan default rate and reduce the stock of non-performing assets. RMA in 2010 introduced an electronic fund transfer and clearance system for automated clearing of the instruments between financial institutions in Bhutan. Again, another important development in the Bhutanese banking sector is the introduction of Visa, MasterCard, MasterCard branded card, credit and debit cards. BOB was the first bank in Bhutan to obtain membership from the Visa International and MasterCard Worldwide Services Networks, followed by BNB and Druk PNB. So foreigners who are traveling to Bhutan are able to use their Master and Visa card, debit card, credit cards to make payment, right? To make payment through a point of sale. Point of sale termination, they can do it. And also withdraw cash from ATMs in Bhutan, right? Also, what happens is Bhutanese travelers who are overseas are able to use their cards to make payments through POS. They can withdraw cash from ATMs outside Bhutan. A problem for the Bhutanese economy has been the ongoing, we know this, Indian rupee crisis, the rupee crisis, which has resulted in a large rupee deficit, which has been financed by the government. So the Bhutanese national currency, that's a neutrum, and the Indian currency have been pegged 1-to-1, right? It's pegged 1-to-1 since the introduction of the national currency. Initially, neutrum was freely circulated in some part in Orissa and North Bengal, certain parts, accepted as a legal tender due to the convertibility of neutrum into rupee. But later, the central bank imposed a measure on the use of rupee, very strict measure, to procure goods and services from India, so which has resulted in a large rupee deficit due to the strong demand for goods and services from India. So the initial year, when the years of introduction of national currency, problem did not persist. Why? Because the development activities in Bhutan were being financed by India. Purchasing power of the Bhutanese people was low because the country was largely an agrarian society. But today, with rapid development and significant economic growth, along with the inflow of foreign aid in hard currency from MNC multilateral organizations and other bilateral organizations, so an increase in the procurement of goods and services from India has occurred. Also, increase in tourist inflows from countries other than India has led to an inflow of hard currency, while most of the goods and services are being imported from India, so which actually has led to the growth in hard currency and the depletion of Indian currency assets in Bhutan. The interest that the central bank is paying to finance the deficit is basically to maintain the peg. So at this point, what happens? Relaxation of the peg would hurt confidence in the financial sector, which would have an adverse effect on the economic growth of the country. Why? Because as most Bhutanese people would be less inclined to save and invest, and as such, the property market, which is the only investment available for Bhutanese investors, has been increasing in Bhutan in line with the rapid increase in money supply. Also, in addition to placing pressure on land and real estates, restrictions on the Indian currency have led to hoarding of rupee in Bhutan. So unless the central bank of Bhutan, that's RMA, provides enough rupees to the Bhutanese on demand, It is very difficult to maintain this one-to-one peg. Very difficult to do. And in addition of note, in the long run, after completion of a major hydropower project in Bhutan, the availability of the Indian rupee will rise dramatically, and Bhutan could suffer from huge excess liquidity if the one-to-one peg is not maintained today. The financial sector in Bhutan has grown over the study period in terms of assets, loans, investment, deposit-based revenue, profit. Return on capital and return on loan and investment of the sector was impressive as compared to the international standards. The analysis actually finds out that in terms of return on capital and also efficiency, BNB was the most efficient financial institution in Bhutan. Why is it? It could because it started fresh with a manageable business size. In terms of liquidity and capital adequacy, BOB seemed to be more secure and stable, while BNB was much leveraged. So BOB has more room to expand provided it expands its deposit base and does not lose out to new banks, right? Okay. The economy of Bhutan is projected to expand rapidly, followed by the three actions. One is implementation of several joint venture projects between Government of India and Government of Bhutan. Second is opening of tourism sector. Third is taking measures to liberalize the economy to attract direct investment. Fourth, establishment of some SEZ, special economic zones, to promote uh, multinational corporations to come up and establish their business, right? And also to promote trade, to efforts to liberalize the power sector for the private sector, and establishment of information technology parks, that IT parks, move to allow the leasing of agricultural land and large agro companies, establishment of new banks. So, in line with the expanding economy, the financial sector of Bhutan is also expected to actually witness a tremendous growth and experience major changes in the next decade. In recent years, Bhutan has taken steps to deepen the financial sector. How? By establishing credit and collateral registries, right? So the Credit Information Bureau, CIB, was established within RMA in 2009 to actually help in monitoring of borrowers so that to improve access to credit, right? So the Central Registry for Secure Transaction for Movable Properties was established also in 2014 to encourage secure transactions and ease collateral requirements imposed by lenders, which actually improve the access to credit, right? In 2013, CIB was dealing from RMA, and today it has become an independent institution. Right. Today, it is used by all the financial institutions of the country, and it covers all loans except for informal microfinance. It's covering 97% of individual and 50% of corporate borrowers, right? And which these new entities have actually helped lenders to have a help in identifying their sound credits so that they can expand lending, especially to SMEs, small, medium, and big enterprises. Ministry of Small and Medium Enterprises that we have. The Ministry of Finance has also begun to issue treasury bills in 2009 for fiscal management and monetary policy. There is a system for electronic funds transfer and clearing was put in place in June 2010, which allows for electronic transfer of salaries, dividends, utility payments. In 2011, RMA began operation of the Bank Financial Switch, which is a national card switch system for ATMs and point of sale terminals. And at that time, RMA also made available to the public the National Electronic Funds Transfer System to transfer funds amongst individuals and also between institutions. 2014, RMA, in consultation with Ministry of Finance, Ministry of Economic Affairs, they formulated the capital markets master plan, right, for Bhutan for 2014 to 2024, which actually would help in lessening reliance upon commercial banks by providing alternate sources of financial intermediation. That includes microfinance intermediation, both depository and non-depository. RMA also has established Financial Stability Unit in 2014 to monitor and assess the risk which arises from the financial system. There's a last topic that we have, that is financial crisis in advanced economies. Right now, a well-functioning financial system, they can solve the asymmetric problems, information problems, that is both moral hazard as well as adverse selection, so that capital is allocated to the most productive uses. These the asymmetric information problems that is there, which act as a barrier. This is acting as a barrier for efficient allocation of resource of capital. They are actually also known as financial frictions. That's what how the economists talk. Frictions to financial frictions. So when the financial frictions are increasing, what happens? All the financial markets, they're becoming less capable of channelizing the funds efficiently from savers to households and firms with productive or investment opportunities. With the result that what happens, the economic activity starts declining. Financial crisis occurs when information flows in financial markets experience a large disruption. Disruption with as a result of which the financial frictions it increases quite sharply. Financial markets stop functioning. Then what happens? The economic activity will also collapse, right? So we will talk about financial crisis in advanced economies, right? How does it go about? It has increased in two, sometimes three. It takes progresses in two steps, sometimes in three stages. So generally, we will talk about three stages. So stage one, that's the initial phase financial crisis, can begin in two ways, either through a credit boom and bust, or a general increase in uncertainty caused by failures of major financial institutions. So credit boom and bust. The Actually what happens, the seeds of a financial crisis are generally happens when an economy introduces new types of loans or other financial products. It's known as financial innovations. Or when the countries are engaged in financial liberalization, there is all the restrictions are eliminated on the market, on the financial markets and institutions. So in the long run, what happens, due to financial liberalization, it promotes the development, financial development. It encourages a well-run financial system, which will help in allocating the capital efficiently. But there's a negative side to the financial liberalization also, dark side. What happens? In the short run, it will actually prompt or instigate the financial institutions to go on lending on and on, right? Which is called a credit boom. Now, what happens? It's an unfortunate situation that the lenders may not have the expertise. Everyone may not have the expertise or the incentives to manage the risk, manage it in the right way in these lines of business. So, but even if there is proper management, credit boom at times what happens? It goes up beyond the ability of the financial institutions. They would just go on giving beyond their ability, and and government regulators, right, to screen and monitor credit risk. So they would just go on like beyond the government regulators. They monitor to see what will be the credit risk. So there's a certain amount of risk. You should not go beyond that. But these financial institutions get overexcited and they start lending beyond that risk, which leads to actually overly risky lending. And the government safety nets, right, which is the deposit insurance, weaken market discipline, and which actually weakens the totally market discipline and increase the moral hazard incentive for banks to take a greater risk than they would otherwise would do it, because government is saving them, right, it's protecting. So why? Because these lender savers, they know that government guaranteed insurance would protect them from losses. So they will supply even undisciplined banks with funds. Government would do that. So without proper monitoring, what will happen? The risk taking grows unchecked, right? And ultimately losses on loans begin to mount, and the value of the loans that starts falling relative to their liabilities. So thereby what happens? It drives down the net worth of bank and other financial institutions. When there is less capital, what happens? These financial institutions cut back on the lending to borrower spenders, which is a process called leveraging. Deleveraging is when you start cut back on the lending system, right? So what happens? With less capital, banks and other financial institutions become riskier, so which is causing the lender savers and other potential lenders of these institutions to pull out their funds, right? Few funds means few loans to fund productive investments, so credit freeze happens. Thus, the lending boom turns into a lending crash, right? And when financial institution stops collecting information and making loans, financial frictions will arise, which limits the financial system's ability to address the asymmetric information problem of adverse selection and moral hazards. Because loans become scarce, what happens? The borrower spenders are no longer able to fund their productive investment opportunities. They don't have money, they cannot borrow, so they decrease their spending, which causes the economic activity to contract. The second cause could be as I said, is the asset price boom and bust prices of assets, right? Such as equity shares and real estate. Real estate can be driven by the investor psychology, well above the fundamental economic values. That is, the values based on realistic expectation of the asset's future income streams, right? So rise of asset prices above the economic values is an asset price bubble. Now, asset price bubble are also driven by credit booms, where what happens? A large increase in credit is used to fund purchases of assets, thereby increasing their prices. Now, when the bubble bursts, at that point it will burst, and the asset prices realign with the fundamental economic values. So stock and real prices starts falling. So companies see their net worth decline, value of collateral these companies can pledge, their collateral value declines. So what happens? Companies have less at stake, so they are more likely to make more risky investments because they have less to lose because they have less money, right? So they can take it. So the problem of moral hazard. As a result, what happens? Financial institutions tighten the lending standards for borrowers and lending contracts also. So the asset price bubble also causes a decline in the value of the uh, assets of the financial institutions, resulting in a decline in the institution's net worth and also a deterioration in their balance sheet, which causes them to deleverage, steepening the decline in the economic activity. This deleverage happens and the economic activity goes down, right? There can be a third reason also, increase in uncertainty. So financial crises have usually begun in periods of high uncertainty, such as just after the start of a recession or the crash in the stock market or the failure of a major financial institutions, where its information is hard to come by in a period of high uncertainty. So financial risk will increase. The people don't have all the information, and which results in reducing lending and economic activity. Stage two is banking crisis. Now, deteriorating balance sheets and tougher business conditions that leads to some banking institutions into insolvency, right? Which happens when their net worth becomes negative. So they are unable to pay off depositors or other creditors. Some banks actually go out of business, right? Uh, what happens? In severe cases, these factors can actually lead to a bank panic, in which multiple bank panic means where the multiple banks actually fail simultaneously, right? What is the main source? Source is asymmetric information. So in a panic, what happens? Depositors fearing for the safety of the deposits, right? And not knowing the quality of the bank's loan portfolios, they would start withdrawing the deposits to the point that the banks start failing. So uncertainty about the health about the banking system in general can lead to runs on banks, both good and bad, which forces banks to sell off their assets to raise the necessary funds. They have to pay back, right, the money. So they sell off their assets. These fire sales of assets may cause their prices to decline because they're selling and they are in desperate need, so the prices would go down so much, and prices can go down to so much more than so much more that some banks become insolvent, and the resulting can actually lead to a multiple bank failure and a full-fledged bank panic at that time, right? So what happens with few banks actually operating, information about the credit worthiness of the borrower spending disappears, right? So, and increasing severe adverse selection, moral hazards in financial markets, they deepen the financial crisis, which results in decline in the asset prices, failure of firms throughout the economy that lack funds for productive investment opportunities. So ultimately what happens, public and private authorities, they shut down all the insolvent firms, they sell them off or liquidate them. Uncertainty in the financial market then starts declining, right? So after the bank crisis, what happens due to this few banks are there, right? They which are unable to provide the credit worthiness of the borrowers, then what happens? Adverse selection happens, moral problems happen, and some of these firms actually start mm, operating, they are going into risky business, they fail to repay the loans, right? And so what happens, then all these insolvent firms are being sold off, and they're all liquidated. So what happens, gradually all there's uncertainty in the financial market starts declining, and the stock market starts recovering, balance sheet starts improving, so financial crisis friction starts diminishing, financial crisis subsides, and with the financial markets able to operate well again, the stage is set for an economic recovery. Okay, okay, right. That's the stage three, which is the last thing, that the last stage that we have, which is debt deflation. If, however, the economic downturn leads to a sharp decline in the price level, right, then the recovery process can be only for short term. Then we will have debt deflation occurs, where a substantial unanticipated decline in the price level sets in, which leading to a further deterioration in the firm's net worth because of the increased burden of indebtedness. Economies which have a moderate inflation, which is basically where most advanced countries have it, right? Many debt contracts with fixed interest rates are typically of fair long maturity, like 10 years or more. So because debt payments are contractually fixed in nominal terms, what happens? An unanticipated decline in the price raises the value of the borrowing firms and household liabilities in real terms, okay, but does not raise the real value of their assets. That does not, real value does not increase, right? So it just it raises the value of borrowing firms, but the real value will not increase. So the borrower's net worth in real terms thus declines. So, and the substantial decline in the real worth of borrowers caused by a sharp drop in the price level creates an increase again in the adverse selection and moral hazard problems. Lending and economic activity decline for a very long time. That's what happens. Okay, so that's all that we have up here, right? Okay, right. So that's all that we have for you from here. And we will, if you have any questions,